Somewhere in a box in your parents' garage, there's a mortgage statement from the 1990s. The number on it looks like a typo. 80 grand, 90 grand, maybe low six figures if they bought somewhere fancy. That same house, same street, same 3 bedrooms, and the same cracked driveway is now worth 3 to 4 times as much. Your paycheck did not triple. It didn't even double for most people. Here's the part that should actually bother you. This isn't a personal failure. It's not because you bought too many lattes or didn't hustle hard enough. It's because the entire cost structure of an ordinary American life quietly detached from ordinary American paychecks. And almost nobody sat you down to explain it. Today, we're going to walk through exactly where the math broke, why the just budget better advice from a decade ago is functionally useless in 2026, and what a realistic path to financial stability actually looks like when the rules changed without anyone announcing it. Let's start with the biggest line item in almost anyone's budget, because this is where the gap is impossible to argue with. As of mid-2026, the median price of an existing home in the U.S. sits right around $400,000, and new construction is running even higher, closer to $425,000. That's not the median price in San Francisco or Manhattan. That's the national median. Half the homes sold are more expensive than that. Now put that next to income. The Census Bureau's most recent official read on median household income landed around $84,000, and even generous private trackers estimating faster 2026 wage growth only put it somewhere in the high 80,000s. So you've got a median home costing roughly 5 times the median household income before you even touch a mortgage rate. And the rate isn't helping. 30-year mortgage rates spent 2021 near historic lows around 3%, then rocketed into the 7% range by 2023. In 2026, they've cooled off a little, hovering in the mid-6% range, but a little better than terrible is not the same as affordable. On a $400,000 home with a typical down payment, that rate difference alone can mean paying several $100s more per month than a buyer locked in just 4 or 5 years earlier. Here's the trap. Almost nobody names directly. When the math doesn't work, people don't walk away. They stretch. They tell themselves the payment is a bit much for now, and that a raise or a refinance will fix it later. Financial planners generally recommend housing costs stay under 30% of gross income. A lot of buyers in this market are quietly signing up for 40%, sometimes 45%, and calling it temporary. That's not a housing decision anymore. That's a bet against your own future income, made under pressure, with a 30-year contract attached to it. If housing is the biggest structural problem, cars are the biggest self-inflicted one, and the data on this is almost comedic if it weren't so expensive. As of early 2026, the average monthly payment on a new car loan is around $770. Not the price of the car, the monthly payment. Some full-size trucks and SUVs are pushing past $1,000 a month on their own, and roughly 1 in 5 new car buyers is now financing at that 4-figure level. Loan terms have stretched right along with the payments. 6-year loans are now the norm, and 84-month 7-year loans are becoming shockingly common, especially among buyers who can't otherwise make the payment fit their budget. Run the numbers on a 7-year loan at current interest rates, and you'll find people paying well over $100,000 in total for a vehicle that will be worth a small fraction of that the day the loan finally ends. Here's the uncomfortable reframe. A car is not an investment. It is a depreciating tool that gets you from point A to point B. The moment you drive it off the lot, it starts losing value, and every extra year of financing is another year of paying interest on an asset actively shrinking in worth. None of this is a moral failing. Car prices themselves have jumped substantially in the last several years, partly from supply chain disruption, partly from tariffs on imported vehicles and parts, and dealers know exactly how to make a $1,000 monthly payment feel manageable by stretching the term until the number looks survivable. It isn't a coincidence that this works. It's the business model. Let's zoom out from any single expense and look at the whole picture, because the individual numbers only tell part of the story. Multiple recent cost of living analyses have put the income needed for a single adult to live comfortably in a major U.S. metro area somewhere north of $100,000 a year in 2026. For a family of 4, that comfortable living threshold climbs well into the $250,000 plus range in a lot of markets. Read that again. $250,000 for a family to feel comfortable, not extravagant. That's not private jets and vacation homes. That's rent or a mortgage, groceries that have gotten noticeably more expensive since 2020, health insurance premiums, and maybe childcare if you have kids, which in a lot of cities now rivals a second rent payment. Here's the number that really exposes the disconnect. Multiple surveys in 2026 have found somewhere between 40% and 60% of Americans describe themselves as living paycheck to paycheck, and that includes a meaningful chunk. Some studies say around 4 in 10 of households earning 6 figures. That's not a low-income problem anymore. That's a structural problem that reaches deep into what used to be considered a comfortable income bracket. A household pulling in $120,000 a year in a high-cost city with a mortgage, 2 car payments, and daycare can have less breathing room than a household earning half that in a cheaper part of the country with no debt. Income alone stopped being the whole story a while ago. What matters just as much is the gap between what comes in and what's already spoken for before you see it. There's also a regional split worth knowing about. Some of the sharpest increases in financial strain in 2026 have shown up in parts of the South and West, where population growth has pushed up housing and everyday costs faster than wages could follow. Meanwhile, some Northeast and Midwest metros, despite having a reputation for higher costs, have actually seen slightly more stable household finances, partly because wage growth in those regions has kept closer pace with inflation. The point isn't that any one region is safe, it's that middle class now means wildly different financial realities depending entirely on zip code, which makes blanket advice like just save 20% almost meaningless without knowing someone's actual cost of living. There's a psychological cost buried inside these numbers that rarely gets discussed. When the gap between what a comfortable life costs and what I actually earn keeps widening every year, it doesn't just strain a budget, it changes how people feel about their own effort. A lot of people working full-time, sometimes 2 jobs, doing everything that used to be considered responsible, are ending up further behind than they expected to be at this stage of life. That's not laziness. That's the cost curve moving faster than the income curve. And it's worth naming clearly instead of letting people quietly assume it's their own fault. This is where a lot of financial content gets it wrong. So let's be precise about the actual argument here. Skipping a daily coffee saves you maybe $150 a month. Making your own lunch saves a bit more. These aren't bad habits to build, and small savings do add up over a year. But when the median home costs 5 times the median income and the average car payment eats close to $800 a month on its own, no amount of coffee skipping closes a 5-figure annual gap. Since 1990, U.S. home prices have climbed roughly 400%. Median household income over the same stretch has grown by a much smaller multiple, generally cited somewhere in the range of 150 to 200%, depending on which income measure you use. That gap is the entire story. It's not a spending problem at the individual level. It's a structural mismatch between how fast the big-ticket costs of an ordinary life have grown versus how fast paychecks have kept up. This doesn't mean budgeting is pointless. It absolutely still matters, especially for controlling the expenses you do have leverage over. But it means the old script of cut small expenses and you'll get ahead was written for an economy where the big expenses were still roughly in line with income. That economy is gone. Pretending otherwise just makes people feel like personal failures for a problem that's much bigger than their spreadsheet. Now, for the part that's actually useful, because pointing at a broken system without a plan just leaves you anxious. There's one specific savings milestone that changes how your entire financial life feels, and it's not the one people usually talk about. If you invest $500 a month at a typical long-term stock market return around 8%, it takes roughly 10 years and 8 months to reach $100,000. That's a long runway, and during almost all of it, you're doing the heavy lifting. Compound growth barely moves the needle in the early years, but there's a smaller number that arrives much sooner and matters more psychologically than people expect. $20,000 in accessible savings. Below that threshold, every surprise expense becomes an emergency. A transmission repair, a broken bone, a busted water heater. These aren't just annoying, they're crises that force you into credit cards, payday loans, or a call to family. You end up making decisions out of fear. Staying in a job you hate because you can't survive 2 weeks without a paycheck, not negotiating a raise because you're scared to rock the boat, never starting a side project because you need every dollar of guaranteed income. Cross the $20,000 line, and the same transmission repair becomes an inconvenience instead of a disaster. That shift isn't about the number itself, it's about what becomes possible once fear stops making your decisions for you. You can consider a lower paying job with better long-term upside. You can negotiate harder because a rejected offer doesn't sink you. You can test a business idea for 6 months without betting your rent on it. Financial advisors talk about risk tolerance like it's a personality trait. It mostly isn't. It's a bank account trait. The exact same person makes completely different decisions with $500 in savings versus $20,000, not because their character changed, but because their options did. If you take one tactical piece away from this video, make it this, because getting the order wrong is the single most common way people sabotage themselves. Step 1. Take any employer 401k match in full immediately. If your company matches 4% of your contributions, put in exactly 4%. That's an instant 100% return on your money before it even touches the market. There is no investment on earth that reliably beats free money. Step 2, attack high interest debt before anything else. If you're carrying a credit card balance at 22% interest while also putting money into index funds hoping for an 8% return, you are mathematically losing around 14% a year, guaranteed. Paying off that debt is a guaranteed double-digit return that beats almost every investment strategy that exists, including what most professional investors manage over their careers. Step 3, only after the high interest debt is gone, build the $20,000 buffer, then invest consistently beyond that. The reason this order feels unsatisfying is that debt payoff produces no visible reward. There's no new purchase, no vacation photo, just a number on a screen creeping down slower than you'd like. That's exactly why so many people abandon it halfway through and go back to investing while still bleeding interest payments. The lack of a visible win doesn't mean it isn't working. It means the win is invisible until the debt disappears completely, and then the same dollars that were funding interest charges suddenly start funding your own future instead. There's a social cost to doing any of this that almost nobody prepares you for, so let's say it plainly. If you buy a reliable used car with cash instead of financing something flashy, some people will notice. If you get a roommate at an age where that used to feel embarrassing, family might have opinions. If you skip the renovation your friends are doing and instead put that money toward debt or savings, it can genuinely feel like you're falling behind while everyone around you moves forward. You're not. They're often financing an image with money they don't have yet, and you're quietly buying yourself options. The trade-off doesn't photograph well, and nobody posts a picture of a paid-off credit card balance. But it compounds in a way that a financed truck never will. The system profits when you stretch. The lender wins when you take the bigger mortgage. The dealership wins when you sign the 7-year loan. None of that makes any single purchase evil, but it does mean the path of least resistance is rarely the path that builds actual financial stability. None of this means the situation is hopeless. And it definitely doesn't mean you did something wrong by struggling with math that genuinely stopped adding up somewhere in the last 2 decades. It means the target moved, and the old instructions for hitting it are outdated. The order that actually works is boring. Grab the free employer match, kill the high interest debt, build a real buffer, then invest with consistency, and let time do what it does. It won't feel exciting for a while. But boring and working beats exciting and broke every single time. If this helped make sense of numbers that felt overwhelming, subscribing keeps videos like this coming, and if you want the deeper breakdown of exactly where every extra dollar should go once your debt is cleared, that's coming in a follow-up video. Thanks for watching.